Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Melody Wright of M3 Melody Substack, who is a writer on X and has been on multiple platforms talking about the housing crisis and the issues within the U.S. economy. How you doing today, Melody?
I'm doing well. Thank you. How are you?
I am doing pretty good for the most part. Obviously, the markets are tanking right now. The markets continue to, well, I don't know if you can call it a tank on a historical level.
Right.
But, I mean, you still see like the broad indices, they're still above, closer to their all-time highs. I mean, the Dow's above 50,000 and such. But many of these equities, especially in the sector that many investors that watch the show invest in, like mining, gold, silver, and such, those have been plummeting. So, yeah, it's you can see it as an opportunity, or you can see it as no pain, no gain. So, it's
Right.
kind of one of those things.
Right. Yeah, it's a little nuts. Last Friday was quite I think, jarring for most people just to watch. And, honestly, I watch the bond market more than I watch anything else. And because of, its relationship to housing, because mortgage rates follow that 10-year treasury. So on Friday, when you think about where we thought we were going to be coming into the year, we thought we'd have lower mortgage rates, and now, that's just not the reality, and they just keep going up. So I think it's kind of crazy out there right now, and I think that the impacts from the war, I don't think we've even really started to feel yet. So I'm thinking it's going to be a pretty funky fall, is what I keep sort of saying, just with all the different macro headwinds that are going to kind of come together in the fall.
Yeah, definitely. So let's jump into the bond market. So what is the bond market currently saying? I mean, we have the 10-year yield. The yields just keep rising and such. There's some speculation that when the yields get to a certain level, there seems to be some form of intervention to try to cap them in the background or whatnot. How are you viewing this, the bond market?
So I'm laughing because there's just, there does seem to be that kind of manipulation going on. You can just see the fight. You can see, like, I have a program called MBS Live Dashboard. And so I'm watching real time pricing on those, and you can see the fight to when it gets to a certain level. Like it's just a fight. And so I do believe we're seeing some intervention. And I do believe they're doing, whoever, I don't know, but really just market movers, acting in concert. But what the bond market is telling me right now is they don't have any, and, I get in trouble for saying this, but they don't have any faith in the Fed. And it's pretty much, dictating things right now. And with the 2-year over 4, that it's really saying, if you believe, as some people do, that the bond market speaks, it's saying to the Fed, you need to raise rates. I, for one, think it's more that there's some structural issues in the bond market. You've got a lot of hedge funds, kind of shorting it. You also have people selling off the long end of the curve because, I don't know about you, but I'm not going to own a 10-year treasury, not with our debt situation the way it is. And so when Turkey got into trouble, they sold their gold, they sold their treasuries. So I think you're going to see more of that happening as different countries need to sustain their currency. So there's a million reasons, and so everybody has their thesis on what's happening in the bond market. I, for one, think it's multiple things, but the main message is that right now rates aren't coming down.
Mm-hmm. So what happens with currently we're paying a lot of money in interest on the debt, and these yields rising means that we got to pay borrowers or we have to pay lenders, more higher yields on the bonds and such, which I imagine just increases that interest cost. What do you think about that?
Well, I've kind of come to the conclusion, and this is very recent for me, but I've stopped listening to what the administration's saying. I'm just watching what's happening, right? And then the actions that they're taking. And honestly, it feels as if we may get to a point that we restructure our debt. And that's hard for people to accept, that we might default, we might restructure. But I mean, we are not making any friends geopolitically right now. I mean, we are pretty much making everyone upset except for a handful. And so it just feels like we've gotten to a point where the realization has occurred that we're in a corner and there's nothing we can do. And therefore we must restructure the debt, because you're not going to be able to inflate it away. And not without the pitchforks really coming out. And, I think that already the anger out there is it's real. But if you don't go out of your house very much, like many of us don't, because either you're working from home or you go from your home to your office and back, and you don't even talk to your neighbors anymore. I think we don't even understand how bad it is. But when I go out on the road and I go to the homeless shelters, I go to the food banks, like we are living in, if you remember the bread lines during the Great Depression, like just because people have SNAP cards, it's basically the same thing. Mm-hmm. It's just hidden in their pocket versus standing in line, but they're still standing in lines, even with those SNAP benefits at these food banks. So, I think that we're stuck. And so I think that the debt, I think they'll probably, I know this, so I'm talking to a metals show, so mm-hmm. This may not be as crazy, but I do believe that we might be moving more toward trading in gold, because we've lost the faith of other countries, is what it feels like to me. And so we may be moving more back to some sort of gold-backed system, maybe not like it was previously, but something. So, that's where my head is right now watching this, because this war makes zero sense, and so what could it really be about? And that to me, it may be about our economic situation.
Yeah. So I'm curious, what do you think this default or restructuring of the debt could look like? Some speculate that we could potentially, like you mentioned, go back to some form of gold-backed currency, or link treasuries to gold, or revalue the gold and such. There's been speculation that on the 250th anniversary that's going to happen or whatnot. Right. But at the end of the day, like I don't think no one can say with certainty that that's going to happen. What are some other ways this could look like?
I mean, I think it could just be an announcement one day, 10-year treasury, this is what it's worth now. That's it. It's hard to even imagine. But again, I'm sure people didn't imagine they were going to have to get their gold confiscated, during the Depression. So I think that, we could be looking at, as I say, the fall is setting up the commercial real estate, your hard maturity wall. So what's been happening is everybody's been talking about maturities, debt maturities for commercial real estate. But in reality, they had sort of the ability to extend, right? Well, you've got hard maturities coming due in the fall and loaded Q3 and Q4. So there's just all these things from an economic perspective. And we all know the labor market isn't doing as well as anyone wants to say. So it could be that we are in such economic distress, like that announcement doesn't even seem wild. Mm-hmm. But, we shall see. We have been living on borrowed time for so long. I think that many of us can't even believe that an end is coming to that borrowed time. And so it's hard to imagine. So I don't know exactly how it could happen, but that I just sense that's where we're headed. Yeah.
You mentioned a really good point about the job situation. So I've worked with some college interns and had them work in some of the fields that I've worked in, and they've had some issues like getting out of college, finding employment, and such. That's been a major consistent theme that I've been hearing from college graduates as well, and so that's very concerning. And I was thinking about one of your titles on your X page is GFC survivor, GFC one survivor, or something like that.
Yeah.
And I was kind of wondering, like, are there some similarities there? So during the GFC, just for context, I was working at a warehouse job. I just graduated high school. I heard the word recession. I didn't know what the hell was going on.
Right.
I was just oblivious to everything, and so I wasn't paying attention to any of the signs or anything like that. But are you seeing any similarities with that experience and what we're seeing today?
Oh yeah. I mean, it's so discouraging because, I spent feels like half my life. It wasn't, but just trying to get us out of it. And there was a small group because I was part of the consortium. My former company was part of the consortium of 5, which was Wells Fargo, Bank of America, Citi, Chase, my former company, GMAC, which is now largely Ally Bank. And so, what we thought we were doing was saving the world, saving the economy. Like, we were working nonstop trying to figure out how to, keep everything from imploding. And then after the fact, I tried to make sure we never got into that situation again. So, but now I'm seeing that we're exactly there again. And what happened this time is instead of private lenders doing subprime, it was the government. And, they did FHA, I call it government subprime, as low as 500 with compensating factors on your credit score. And so this stuff it's been going delinquent since June of 23. They did some aggressive, even further loss mitigation, et cetera, in it. So we've just, again, slowed it down. But I'm seeing a ton of similarities. And then also, the derivatives market has gone insane again. And I think that what we learned during the GFC was just how to do it bigger and better because nobody got in trouble. And so, yeah, I definitely am seeing similarities. I'm seeing a lot of differences too, just because we did so much massive intervention after COVID before everybody kind of got into trouble. But you're now starting to see issues in mortgage, in the prime books as well as the subprime. So, and that's going to change the game from a housing perspective. And then, private credit, I think that, is a canary in the coal mine, and that's so systemic. And it's not, everybody quotes that $1.8 trillion. It's so much bigger than that. And it's got its tentacles around everything. And you can't really look at private credit without looking at private equity. And so I think we could actually see a credit event as well. So, unfortunately, very similar in many ways.
Mm-hmm. So when you're looking at the housing market, so obviously 2020, 2021, 2022, interest rates were low. The Fed cut them down to zero after the pandemic hit, and then just these housing prices just boomed to like these astronomical levels. At that point, I actually have my real estate license, and I remember working with some clients, and they were getting outbid on everything. People selling their properties, paying fully cash, selling their properties in the higher price neighborhoods, and coming over to the community I live in and buying houses for cash and such.
Speculation.
And it was pretty. I mean, some people were waiving inspections.
Oh yeah, and appraisals.
And then they were doing some outrageous stuff. Mm-hmm. And so we had that boom, and then it seemed like it was it slowed down significantly once interest rates started to rise. The Fed ended up pivoting on rising interest rates, but those housing rates still remain elevated. And so is the activity similar, or is the activity slowed down dramatically? What are you seeing?
Yeah, no, the activity has slowed down dramatic. I mean, basically the housing market has been frozen for 3 years. I mean, you can look when you look at actual sales, they always talk about the seasonal number and it makes it very difficult to understand what's going on in housing. But when you look non-seasonally at just the sales year over year, 23, 24, 25, they're like, and they're tracking 2008 absolute sales. And we've increased population by 20% since 2008.
Wow.
So these sales are way worse than the crisis. So housing market's just frozen. But what so many people, Darrell, don't understand is what you just said. It wasn't about, Joe and Jane getting their first house. It was about people speculating that Joe and Jane would want to get their first house or for Airbnb or for long-term rental. It was all of those things. And they were taking the cash they were getting from somewhere else. And so that drove up because you had a nation that was obsessed with fix and flipping. Like, you couldn't turn on a television without one of those shows. And that really got started at the end of the last crisis because what happened is Fannie Mae and Freddie Mac and FHA begged institutional investors to come buy up the homes. I mean, because we were looking, everybody's like, oh, it was terrible, this housing crash. Well, it was going to be a lot worse than what actually happened. But they came in, they bought them all up, especially in areas like Atlanta, San Antonio, to do long-term rental. Well, then everybody started doing fixing and flipping. And then COVID hits and you've got PPP, you've got all this money, all this stimulus coming into the system, and everybody becomes a real estate investor and they become an Airbnb. They pivot from long-term rental because the banks tell them, well, if you do short-term rental, then you're going to make a ton more money. You're going to make 10 grand a month instead of 1,500. So do that instead. And so now we have markets that are so oversaturated because everybody took that speculation and thought it was an inventory shortage, like a shortage of actual homes. In reality, they're just misallocated. And so then the builders went and built a ton, and now they've completely overbuilt. And so the market's frozen. Sellers are delusional. They're rage delisting because they can't get the price they want. Those inspections are coming in, and they're like, hey, they think that they didn't have to do any repairs because last time when they bought it without that inspection, right? But when they're getting to the closing table, it's like, no way, there's something wrong with your roof. There's this, and this. And so, it's a really bad housing market right now. And of course, CNBC yesterday was like, oh, a surge of home sales. It's like, no. This is the spring selling season. We should be, on average, home sales rise 10% month over month from April to May, going all the way back to 1999. So a 3% rise month over month. It's not something to write home about.
They know how to word them headlines, huh?
Man, they know. They know. Like, it is just hilarious to me. And that, I'll tell you what's different about this time around is I was oblivious, Darrell, to how the press really participated in all this. But now I'm just like, and these economists like Mark Zandi or, the National Association of Realtors, I mean, they're just a joke. They're just selling headlines. So, yeah, but the housing market it's terrible. It's just, I, for one, I'm one of the only housing bears out there that was saying, I would love to see lower rates. Because with lower rates, we're going to get price discovery because I can tell you this trend has now been completely confirmed in the 80 plus markets I track. Lower sales mean higher prices, except for some really depressed markets, because it's only the people that can transact, and they're transacting higher price with higher price homes. So, But yeah, it's not a good time in housing. You're lucky you're doing something else.
Yeah, for sure. Yeah, I still got some friends in the industry that the activity definitely slowed down. So I actually sold my house last year, and I had to kind of cater to some of the buyer's terms. So it was totally different from a few years ago or whatnot. Right. I had to replace the septic, system and all type of stuff. It was quite a few expenses, and now I rent, and so I'm curious in your thoughts. If you were out of the market, so let's say you didn't own a home or whatnot, whatever your situation is, Would you rather buy or rent right now? Rent.
Oh yeah.
Wow.
I mean, it's just cheaper, and so it's if you're not in your forever home, like this is not a good time to be a homeowner. And if you have some type of option, and there are those people out there that's all they want is to own a home, and I get that, but that's your forever home. You're not trying to own a home to sell it in 2 years and make a whole lot of money. But that's how most people look at the market. They look at that home as like, oh, I could sell. That's my wealth. I could sell that. But definitely rent. It's cheaper to rent in almost every city across the country, and it's actually cheaper than you think because these folks are giving concessions like 3 months free, or I'll pay your cable all year, or something like that. And so I tell people that are renting, really negotiate, because we built so much multifamily, plus all that long-term rental I was telling you about. Because what are these rage delisters doing? They're taking their house off the market and they're trying to rent it. And so there's a plethora of supply, so you can play hardball on rent, unless you're in one of those neighborhoods that everybody wants to get into because of the school or something like that. But yeah, we have so much supply in multifamily; it is insane. So yeah. Rent all day long.
Yeah, for sure. Because if I were to compare what I pay for rent compared to if I were to buy a home, because when I sold my home last year, and this home was not our forever home. We bought it in 2019. Family outgrew it and such, and we had a really low interest rate on it. So that was kind of the biggest part that I was I don't know if I want to give up the 3%, whatnot, but. I'm not finna go buy a home at freaking 7%. No, it's not happening. So, so we decided to rent. And then, and I'm looking at okay, if I were to buy a home today, I would be paying probably about $1,500 more a month to own that home versus renting. So I'm I think I'll pass.
Right. I mean, you could deploy that money somewhere else. And, property, people are like, well, if home prices come down, property taxes will. Well, unfortunately, no, because all of these municipalities went and spent that American Rescue Plan money like drunken sailors, and they got used to all this money. And for some reason, Darrell, everybody was delusional that all that relocating that was going to come to their town. And so everybody was going to have population growth, which that doesn't make sense if you think about that narrative. And so all of these city planners built their budgets around this population growth, and all of them seemed to think they were going to be some kind of tech hub. I mean, look at what's happening in Seattle right now. I mean, in the housing market in Seattle proper, it's a bloodbath. So, and also because of layoffs and things like that in the tech sector. So, yeah, no, I mean, I think if, I don't like to give advice because everybody's life situation is so different. But if I were to give advice, what you did is exactly what I would have told everyone to do, is go ahead and sell it. It was right for you. It might not be right for somebody else, but you're saving money. And those property taxes, they will come down eventually, but they're not coming down for a few years. And insurance is certainly not coming down. And we've got another El Nino, warming up and we're going to have all kinds of flooding. And, we didn't have a big hurricane last year. We had 2 the year before. We're probably going to have a big one this year. So insurance is only going up. So owning a home right now just does not make any financial sense, unless you are, you own it outright but a lot of people, even that own it outright, they say now their property taxes are like a mortgage.
Yeah. I'm originally from Oklahoma City, and
you know about storms.
yeah, for sure. Yeah, tornadoes for sure. Tornado Alley. So there's this term, that folks would use, growing up called shacking up. It had different.
Yeah, it did.
But I'm just thinking about people are moving. Like I know multiple people that are moving in with multiple roommates, or they buy a home and they're getting like, like people are like doing like this more community kind of living to be able to afford like mortgages. And so I'm curious if there's some like data on that. I'm sure there is somewhere. Just curious in your thoughts on that.
Yeah, so there is. So we had seen household formation obviously explode after COVID, again, due to a lot of that stimulus money, and then people got sick of their roommates or whatever. And so you had seen average household size keep coming down. And let me ask you this question. I love asking people, what do you think the average household size is today in the United States?
I would have to say 4.
Right, that's what it used to be. It's 2.57, which is insane if you think about all the different types of housing situations that can happen. And so, but that's now. So for the longest time, that just kept going down, 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 down. Because when I remember it was 4.2, then it was 3.5, and like the other half maybe was a dog, but I'm just kidding. But but now it's even lower, and because we have a ton of vacant homes as well in this country. But now what you're seeing is the reversal of that, and so it's starting to go the other way, where that average household size is going to increase. And here's what I'll say too. Is we are being done a massive disservice with the data we do have. There's holes in it. And, it's kind of crazy that, there's a company called Placer AI. They can tell you where every single cell phone is in the country at any time, but we can't, for some reason, count houses or people. It's kind of nuts if you think about it. But I think we know, and our demographic situation is so abysmal. And, you call it the silver tsunami, you call it whatever, but, there's so many industries that are going to be hit by this. I just recently wrote about student housing and universities. And, while we obsess about the Harvards and you can't get in, really enrollment has gone down significantly. And they call it a cliff. The enrollment cliff will be here in a couple of years because we're not having babies like we used to. And obviously, immigration has slowed.
Yeah, for sure. Yeah, I do want to come back to that point. Just curious if you have any thoughts on delinquencies. Is that something that's picking up or?
Oh, yeah. And I got a text from my colleague, John Comiskey, last night. He just finished reviewing the May MBS data, mortgage-backed security data for FHA. And so what should be happening right now, Darrell, in mortgage delinquency, like everything, it has a season. And this is the season when delinquencies should be caught up because you get your tax refunds, you get your bonus payouts if you're in corporate. March is a typical bonus payout month, or sometimes January. And so what you historically see is delinquency improves. It peaks kind of at Christmas because think about it, like all the Christmas gifts, that kind of thing. And then it just comes down through the spring. That's what's supposed to be happening. That's not happening. And, so we had so much artificial suppression of foreclosures, of delinquency. And so it's coming off of a very low floor, but you now have foreclosures up 26% year over year. That is only going to go higher from here. By the time, it's a long, complicated story about all these different programs, but you can put it this way. The most generous aspects of those programs got shut down last October. And so it'll take a year for that to kind of flow through the system. But by Q4, Q1, we're going to have significant foreclosures. And of course, we are already seeing those increases. And as I kind of briefly mentioned, delinquency had really been contained to that subprime book of FHA, government subprime. But what I'm starting to see over the last couple of months in the client books that I look at is you're seeing early delinquency in prime. And that is what most people remember about the GFC is they remember the word subprime, But in reality, your foreclosure crisis was the prime because once the credit event happened and people lost their jobs. So that is starting, and you're starting to see it. And so, yeah, delinquency is very much going to be, and I'll quickly say too, it looks low because the agencies, they sell their non-performing assets off to hedge funds. Those hedge funds don't often report those loans to credit. Mm-hmm. And so if anybody goes and looks at the mortgage delinquency schedule that the Fed puts out, be sure and look at the title. It's for the commercial banks only. And they really pulled back from mortgage lending after the GFC because of Basel III requirements. It's the non-banks that do all the lending now. And so that delinquency rate that the Fed watches is not at all accurate. And then they do their household debt and credit schedule, and they use Experian. And like I just mentioned, many of these hedge funds that bought these homes that the agencies sold do not report to credit.
Okay. Got it. So
that's probably more than you wanted to know.
No. That's really good. So I was thinking about, like, with these delinquencies, even in investing, like if I could find an undervalued asset, I'm looking at the margin for error. So like, okay, I think this asset should be valued at this price. I'm getting it at a significantly cheaper price. That gives me a huge margin for error. Similarly, with housing, like if people were buying houses at 7%, 6.5%, whatever the interest rate is, and let's say they're barely making it by, they're barely making the mortgage along with their other bills and such. They don't have a lot of margin for error, I imagine. And then let's say you lose a job or anything of that nature.
Gas prices go up.
Yeah, as prices go up, or you're tired of doing the gig economy side jobs with Uber or whatever the case may be, right? You getting tired, like that stuff gets tiring, like people having to work like extra jobs and more hours, and so you just don't have a lot of margin for error. So it's kind of interesting just thinking of it in that way. Right. Commercial real estate. This was a big one, especially coming out of COVID. It's been referred to as like a bomb, just sitting there. Right.
It is.
Many people were working from home. Many of these commercial buildings were empty. People were locked in the homes, et cetera, et cetera. I know recently, even in, Seattle area, Amazon, Microsoft, and many of these other companies, they were like, hey, you got to start coming back to the office. Right. Curious in your thoughts on the commercial real estate, the state of that.
Yeah. So we were sold the work from home story, Darrell, but in reality, when you go to these cities, so, I've traveled all over the country and I go to the central business districts and you just see this massive vacancy all over the country. And what you realize, like you go to somewhere like Dallas or Austin, is that they decided just to build new towers, not because they're needed. Why rehab this 20-year-old tower when you can get all those fat fees and it's a new construction just develop. It generates so much financial activity around these new projects. And you start to realize that's what this was about. If you remember the very first opening scene of The Big Short, all the skyscrapers being built up, they feed the securitization machine. That's what they're for. And so people have been called back to work, but it has not made the problem go away. And you can look at these downtowns, and there's safety and soundness issues now. Like what I was mentioning in Dallas, there's one. My favorite example is this massive new tower right next to one that's completely empty, where homeless people are living out of the back of it. We found like baby strollers and stuff like that. And so. What
are you doing? You just ended up in the back of these buildings and everything. Like, what?
Oh yeah,
it's
the way you get the story, man. And weirdly, because of what happened here with Helene, I got kind of involved in search and recovery and all kinds of things that has kind of enhanced my investigation skills, I guess, into these things. But yeah, no, this crisis is there. One of the reasons last year and why we haven't seen it just implode completely is because private credit decided they wanted to get into commercial real estate last year. And so they went crazy lending and to these multifamily operators, to these office. I mean, it's really quite nuts. And so, but as I was mentioning, the hard maturity wall this year, meaning there is no extend and pretend left, is we're hitting Q3, Q4, a very big one. And so you're seeing now, there's a great account on X where that's all he does. He just tracks these cells and just it's unbelievable the losses on these buildings. And I've been digging into the securitizations, and again, they're doing the trick of nothing's delinquent, but 50% of the securitizations on a watch list. Well, why aren't we hearing about that from the rating agencies? But we're living in the biggest extend and pretend I've ever seen. But the bill for commercial real estate will start to really come due in Q4.
Okay. And when you say the bill, are you saying like when refinancing has to happen at higher rates? Is that part of that?
Yeah. Well, they've been modifying it. Refinancing, they will have zero options now. So you're going to start to see these go to foreclosure. I mean, just like a lot of them. And nobody wants to foreclose despite all the myths out there about it. You lose money and nobody makes money on foreclosing. So.
Yeah. That's very concerning. So earlier you mentioned kind of the silver tsunami. You also mentioned immigration. And I want to talk a little bit about just kind of so we have this immediate thing, and then we have like, a medium term thing that's on the horizon, and that's this issue of retirement. And so immigration, obviously, baby boomer generation, all paid into this Social Security system. People are having more kids, more children in. And I think it was, the amount of workers to support one retiree was like 5 to 1 or something like that. Now, birth rate has declined to a little over 2, and immigrants were supposed to kind of make up some of that difference, with the birth rate declining and how much it took to support one retiree. And you've had immigration crackdowns and things like that, which I don't know how many immigrants are deported or what, but I imagine there's some type of impacts with that. You got the trust fund scheduled to run out, and people are relying on this. Like I'm seeing older baby boomer generations working at some of the fast food restaurants. I'm seeing them kind of picking up gig economy jobs. I think I had a guy deliver DoorDash, and he looked older, and such. And so, I'm kind of curious in your thoughts on that, because that's coming up soon too. I mean, it was brought up when the whole Doge thing was started last year, and then that kind of disappeared, and then there hasn't been much said about it since. And so curious in your thoughts on that coming down the line.
Yeah, I think that's part of my, thesis that we're going to have to restructure or default on our debt. Like there's no, what are we going to do? And I mean, I've pretty much given up any idea that I've been paying into Social Security since I was 12, Darrell. I was washing dishes when I was 12 years old, and I'm not going to see a dime of that, not a dime, more than likely. And unfortunately, it's so sad, but it's like the media tells us, all the boomers are rich, but in reality, they're not. There's only a handful of them that are that rich. A lot of them are struggling, just like you say. There's no way my mother could live off of her Social Security. She was a nurse. She worked her whole life. I moved her in with me because that, buying a whole other house didn't make sense. So yeah, like this is a really big deal that our society has not really paid attention to. And you can look at Japan and see what kind of issues can be caused by this kind of, upside down demographics. But yeah, I mean, this is a massive, it is a tsunami. It's going to impact every single industry in this country. And I don't feel like we're talking about it enough. In housing in particular, the boomers own most of the homes, and they don't just own a primary home. They own a secondary, third. A lot of them are investors. And so, we know 15.6 million Harvard has told us will leave us by like 2035. Another 26 million, by 2050. Like this is a massive impact to society that no one is really paying attention to. And housing, dire consequences. In Japan, they try to give away their vacant homes. Like you have like people from the United States go and buy them sometimes because they've been abandoned.
Yeah, for sure. So there's like this multi-dynamic, like you got like the people that are sandwiched who have their own children and then they're having to care for, a parent. And then you have also the parents who have the kids moving back in with them and such. That seems like it's sad in a lot of ways, where people have to kind of like navigate that. And it seems like it's harder to live the American dream.
Yeah, it is. And it is hard. In some ways, I'm not against families coming back together because I feel like we have, the erosion of the family in this country has been very impactful. And I'm not like, I love the idea of families coming back together, but not in this way. And it's because it's completely unaffordable. But yeah, I mean, everybody's having to do something else. They can't just work their one job to be able to afford a home.
Yeah, for sure. Yeah. So how are you kind of playing this? So I imagine you're wanting to stay afloat in some way, shape, or form. You're like, okay, I see this problem coming. What are some of the strategies, or just like, are you investing, or are you not? Are you just staying debt free? What's kind of like some of your strategies that you think could help people navigate these storms?
Yeah, the number one is say no to debt slavery. I mean, just say no, because in times of stress, that is what's going to really kill you. It's the debt. I come from, you can probably tell, I was working when I was 12. I don't have we weren't well off, put it that way. I understand people that don't have a lot of assets. And so the best thing that you can do for yourself is remember to vote with your dollars and stay debt free. If you have the means to invest, gold is something I'm invested in, obviously. But I got out of the equity market a long time ago. I tried this is how I am. I tried every kind of, is technical analysis or this or that, and I realized there's no,
Did you do
it's
the meme
a casino.
Coins? Did you do the meme coins?
I didn't do those.
Okay,
No.
right.
I'm too suspicious of, but I was like, no. And so in 22, I got out of the markets completely, except for some miners or some, just a tiny, tiny bit of stuff. But yeah, to me, if I had all the money in the world, I would be, accumulating gold, but I don't. And so I do what I can from an investment perspective, but I moved to rural America, and past 3 years I've been teaching myself how to grow food because I could see that this was coming, and we're looking I think what's going to come down the pike from a supply shortage issue from when we finally do see the impacts from what's happening in Iran, it's going to be massive, and this garden's going to be worth a lot to me, if that makes sense. And so I think and then, like I said, moving my mom in with me so I could save money. those are all the steps that I've taken. And so, I feel like we sometimes think we can't do anything, right? That we don't have any power, but we really do. Even if we have no savings, we can just vote with our dollars, how we do spend them.
Yeah, exactly. Yeah, I remember during COVID, I was watching a guy, there was a lot of talk about the food shortage and the food crisis. And the guy was saying he was buying the cans of tuna from Costco, and they expired in 4 years after you buy them and such, and so he was loading up on those. And so I started making it a habit. Like, hey, I'm going to buy some of these. These don't expire for another 4 years. I'll eat them if the time's getting closer or whatnot. But just making sure I have some of those necessities, and obviously
rice
gold.
And beans. Yeah, exactly.
Yeah. Rice and beans. You take me back to my Dave Ramsey days when he be like, live on rice and beans. Like, I was just like,
yeah. Well, they will do the trick, right? If you have nothing else. So, yeah, just like you and what I've been doing, since the war started, is just buying an extra one of whatever it is whenever I'm at the store. Like, not going crazy, but, I have probably about 6 months or more of my daily supplies now because, I do think this is going to get crazy in the fall.
Yeah, for sure. Well, Melody, appreciate you for your time and everything. Love to have you back on the show sometime. Right. Where can the audience connect with some of your writings? And I know you're on different channels. I know you're on X. Where can the audience find you?
So they can find me at M3 Melody Substack, and I would recommend even signing up for the free version. I try to share so much data in that, so you can sort of do your own analysis if you want to. And then you can find me on M3 Melody, on M3_Melody on X Twitter.
Okay, got it. Well, you all have that information. Thank you all for supporting the channel and watching. Be sure to hit the subscribe button if you haven't subscribed yet. And thank you all for your time. And until next time, Melody.
Thank you.